So, Muathi, let's start with the big picture. That 20% decline, actually closer to a 40% decline over the last 5 years. What's that about? What's happening?
Look, I think certainly, I think there are a few things at work here. So one, liquidity has really gone down on the exchange. So if you look at, by liquidity, I mean the total value of shares traded on the exchange has really been coming down dramatically. And I think compounding that is just the geopolitical risk events that happened a few weeks ago. And as you see a retraction away from emerging markets, then obviously that affects sentiment on the NSE, particularly because foreign participation is such a large component of the NSE. I think the other factor that we also have to be aware is that, I think when you look at the banks, for example, they're only really coming out of the cloud, the overhang from rate caps, because even though rate caps were removed a few years back, without risk-based pricing models being approved, the banks were basically operating as if there was a risk, there was a cap on interest rates. And so they were not really lending. So I think all of this just led investors to basically price in lower growth for the companies and just sort of lower interest. And at the same time, there were a lot of attractive opportunities elsewhere in frontier, in markets such as Vietnam, where we've seen rapid growth. Kazakhstan, until recent wobbles, was also very strong. So I think it's just that a dollar that was coming into Kenya found a lot more competition from other markets.
You mentioned something about the fact that, at least with respect to Kenyan equities, a big chunk of the trading is being done by foreign entities. Where the local investors, where the local retail investors, why are they not looking at the equity market in Kenya and thinking, yeah, that's a place I should probably be parking my money? Is it a cost issue, a cost in terms of the cost of trading the shares? Is it a question of the companies just not being attractive to them?
I think it's a variety of factors. One, if you look at interest rates have been high. Well, government bonds have been attractive. So that has basically crowded out some money that would have gone into the equity market, particularly from local institutional investors. When you look at retail, it's a very good question. What's happened to retail? Because if we look everywhere else across the world, particularly in the, when the pandemic was raging, retail was absolutely on fire, whether it's the US or in Asia, and retail was a key factor in those markets. But we missed that. So the question is ultimately, I think cost is one thing. Certainly there's an element of cost. I think the other element is one of just creating a buzz in the market. There hasn't been a listing in recent years. I think once you create a buzz around stock markets and people start to look at them as viable, liquid ways of putting some money aside, then I think you definitely start to create the liquidity that you need. Because the exchange and the regulator are bringing out products that retail in particular should really be gravitating towards. Things such as day trading. We're getting stock lending now, which hopefully the institutional investors should start to take advantage of. So all of these and derivatives already exist. I mean, these are things that do create an ecosystem. But if costs are too high, then day trading doesn't make any sense. And I think we're currently at that juncture. So hopefully going forward, we'll see costs coming down, and this should spur activity on the exchange.
Indeed. I know we've cracked this joke before offline about, just buying Safaricom, the tier one banks, and going away for the next 5 years. But because they've been the big gainers essentially at the stock market in the last 5 years or so. But is that trend likely to continue in the medium term, essentially once we're past the election dip?
Yes, actually what's puzzling is that in previous election cycles, in the year running up to the election, the equity market actually has a really strong performance. We're not actually seeing this. And what's also quite interesting is that actually the elections right now are fairly, in terms of recent history, fairly benign in terms of what we think of disruption. There isn't the disruption that we normally get. So actually, the political picture is probably a little bit better than it has been in previous election cycles, which should really mean for the equity markets to do well. But I think coming out of the elections, yes, I think investors will suddenly have a clearer picture on the politics and have an idea of who's running the country. And of course, I think whichever administration is in power will have to take some hard decisions, whether it's primarily to do with the debt and the fiscal situation, which of all of them should give people more confidence. The saving grace, I think, Kenya, is that actually shilling had that very dramatic move it had last year. If the shilling hadn't depreciated the way it had, then right now we'll be sitting here in the same boat as countries such as Egypt and Pakistan, who are seeing a lot of, and Sri Lanka, for example, who've had a lot of pressure on their currencies.
Indeed. So what's your investment thesis, at least over a 24-month horizon, given what we know at the moment, for example, particularly with respect to tier one banks? Equity, Stand Chart, they've got, I think, among the lowest loan-to-deposit ratios among their peers. Would they be your top picks? And if so, why or why not?
Yes, I mean, certainly equity is very interesting because if you look at it, it's for the first time since 2015, its return on equity is actually 26%. So hopefully we're now turned the corner and we're heading back to the 30s. So this was a bank that was producing ROEs of 30% quite consistently for many years. DRC is just about to join the EAC. Obviously, equity is a very large bank in DRC, has gained the scale just at the right moment when commodity prices have gone through the roof. So I think equity is very well positioned. And I think the dividend of 3 shillings really should cheer investors in the fact that you're getting growth and you know that they're sitting on almost $4 billion worth of T-bills. So when they start to reposition their bond portfolio for lending, I think you see a very dramatic change in their earnings trajectory. So certainly I think that equity is very interesting to look at it. I think all the banks are cheap, but I think equity in particular has nice momentum, nice story. Stand Chart is interesting. I think, I think what would be interesting to watch with Stand Chart is actually the growth of their asset management business, because that is seeing a lot of innovation. And we've seen that it has had a lot of growth, and that could be a big driver for the bank. And it's also paying big dividends. So I think that is a very interesting one. However, I would caution that just given the lack of trading in the stock, you're more likely to see equity re-rate and price in its growth than you would in Stand Chart, just partly because there's more activity in the game.
Indeed. I'm running out of time here, so I just got room for one more question. We saw an interesting updates to clients from JP Morgan early in the week saying that there's a bit of a dollar shortage in the market, which in turn is slowing down their ability to move capital for their clients out of Kenya. Are you running into a similar problem? What chat are you hearing around this on the market?
No, we haven't heard anything. And, we're very active in the market. So usually these types of warnings come from custodians. So JP Morgan doesn't have a local custody business. So presumably it's a global custodian for someone who has a local custodian who's presumably having some FX issues. So it could be a bank specific issue. And these have happened in the past where certain banks get in trouble with the central bank in terms of their activity in the FX market and are cautioned. So it could be very specific to that, but we yet haven't heard any complaints from our clients, specifically on repatriation issues. I think 2 years or so ago, there was an issue when the exchange rates, when there was almost a black market opening in the exchange rate. And then we actually did hear pressure from our clients that they were getting difficulties in getting dollars. So we haven't had anything yet. So it's a bit murky. However, look, I think the FX market is very opaque. So it's always very hard to know exactly what's going on, which is unfortunate.